The harder part is getting the property, right? It's the skill set to talk to them and to get them an agreement. And the easier part is exiting it. Why? Because right now, it doesn't get any better, I don't think, in time here. It doesn't look it. You've got about in the range, every market's different, but in the range of 20%. If you talk to top mortgage brokers, 20% of their buyers are qualifying right now. Out of 100 apps, they get 17 to 20 through the door. So what about that other 80%? They're not all great rent-to-own candidates for us, but it's a big pool, right? And we have a system that sifts them through to find out which ones deserve to be in a rent-to-own versus they're a mess, like I said, credit-wise forever. They don't deserve to be in a rent-to-own, they're just renters. So it's easier to sell on our program than it is to acquire the property. The key is getting the property.
Welcome to Sterling Insights, Stand Out and Supercharge Your Assets, the go-to podcast for financial advisors aiming to grow their assets under management, stand out in a crowded market, and retain assets nearly forever. Are you advising high net worth clients who own appreciated capital assets? Do you want to help them sell without losing a quarter, a third, or even more of their hard-earned profits to capital gains taxes? Then this podcast is tailored for you. Each episode brings you the latest strategies and expert advice from leading financial advisors, seasoned attorneys, and experienced CPAs. Learn how to maximize your clients' wealth, minimize their taxes, and supercharge your advisory practice with actionable insights. Join us on Sterling Insights, Stand Out and Supercharge Your Assets, where you'll gain the knowledge and tools to set yourself apart and achieve unparalleled success in wealth management. Subscribe now and empower your practice for a brighter, more prosperous future. Welcome to Sterling Insights, Stand Out and Supercharge Your Assets. I'm your host, Roger Silk, and we are joined today by Chris Prefontaine. Chris is the founder of Smart Real Estate Coach. He is a multiple times best-selling author, the host of a top podcast, and with over 30 years in business, Chris helps investors close creative recession-proof real estate deals without banks or personal cash. So if you're interested in how this real estate game works, I think you'll be very interested in our discussion today with Chris. Thank you for joining us, Chris. I'm looking forward to the discussion.
Yeah, glad to be here.
So a lot of people talk about no banks, no borrowing, no cash. You want to give us the 100,000 foot overview, and then we can take a closer look at various aspects?
Yeah, I'll give some context because I've been at this, as you said, for, gosh, this is my 34th year, but the 2008 crash mark, I called it the debacle in my book. I just got crushed. And it's because I was on a lot of properties personally with banks. I was operating under the old conventional way of real estate. And when I came out of that, I just redefined how we do it. And it wasn't like, okay, I want to go market this no money down thing. It was, I have no money, I have no credit. How can I participate in the real estate world still? And after 4 years of getting beat up and felt like I couldn't do anything, I finally got back on the saddle and did exactly that. So we don't use banks. We buy only owner financing, subject to existing financing and lease purchase. So none of those require cash or banks. Sometimes a tiny bit of cash to close a deal, but no gobs of cash and no bank signing, no loans. We started doing our own deals as a family company, and then a demand organically started to teach it. And now we have, gosh, I think we're about 80 markets now. When I say we're in 80 markets, I think this is a big distinction, Roger. So most people market real estate product, right? We're a little different. Like I started as a person doing transaction engineer, and then got pulled into the coaching. So we do deals with students all over the country. When I say we're in 80 markets, we're doing deals with students in those markets. So it's not, hey, here's a product, good luck. It's, let's go do deals together. And we're with them right in the trenches doing the deals because that's where it counts. You go to the fancy seminars and take the courses, and then you go, oh man, I didn't know all this happens when you're out in the real life. So that's just a quick synopsis of how we got here.
So if I'm hearing you, you're both yourself and your students, you're buying real estate, taking over existing loans, minimal cash and no signature.
Yeah, no personal guarantees ever. Because
Okay.
I get beat up badly from it. And so I'll have a call during a week and people say, yeah, I'm interested in your stuff. I've been buying stuff of my own because I have good credit. And I say, great, but A, you're limited. I don't care how good your credit is, you're limited with it, each banking institution. And B, you're signing your life away potentially if there's a hiccup in the 2008 crash and many other crashes. There were hiccups, right? So when you don't do that, you keep your leverage. When you do that, you open yourself up to the bank because they got to do their job too. They got to come looking for you.
How many transactions would you do in you? There's you guys as a business, and then there's you guys in some kind of partnership with
You're
your
right.
student.
Yeah, you're right.
Okay.
So they keep the deals. We're in the deal as a consultant legally, and then we do our own deals. But all total with all parties, we do anywhere between 5 and 10 a month, both family and outside family. So you get to see it's like a microcosm of society. You get to see really good in all these markets we're in what's going on. Because people say, was the market crashing? Is the market doing this? There's no one market. There's all these markets, right? It's just the subsets of each other. So yeah, we do those types of deals all day long with any asset class, but mostly we start out teaching single family because if I get up on stage or did a seminar on Zoom and start talking all these different asset classes, I think it'd be major shiny object syndrome. So just know that anything we do, you can do any asset class, but we start off with singles, or there's been some people in the community that just do mobile parks or just do multis. That's fine too. I just want them to focus on one asset class at the beginning and then we can branch out.
Maybe if it works for you, Chris, you can take a handful of recent deals that are still fresh enough that you can remember some details,
Yeah.
obviously without disclosing anything that might be personal to somebody, and just kind of walk through how it works.
Yeah, structure of it. That's good. Most of my answers, I try to do deals for that reason. I love it. Okay, I'll give you an owner financing one. And the reason I want to start with that, Roger, is our owner financing deals, most of them are with free and clear sellers. So they have no mortgage. It's about a third of the properties roughly in the United States. So it's a great pond to fish in, so to speak, because usually off market. So we did a deal in Massachusetts, and this is a low end deal, but I want to show it to you to show you the potential of our 3 payday system on a free and clear home. It was on the market for about 219,000, I think, with a realtor. It didn't sell. The gentleman called me because I looked at some estate properties his dad had when he passed away, and we never struck a deal because they were trying to clean the estate up. But he had this one left of his own. He remembered me and gave me a call. My son and I went out to see him. He had a house that those realtors didn't sell, and I said to him, "What do you owe on it?" Nothing. What were you expecting to get if the realtor sold? They didn't. But after you paid them and negotiated, he said 183.9. Does a number he had in his head. So sitting on his front porch, I said, okay, we can structure that deal, Don. We can give you 183.9, but we'll do no money down. And we'll pay that with monthly principal payments of $923 a month. And in 4 years, whatever's left, we'll balloon it and pay you off. We structured that deal literally in minutes. Of course, the attorneys had to get it closed. No banks, no money down, except for whatever the transfer tax was, because I can't expect to buy a deal, no money down, but then have them pay the transfer tax. So we paid the transfer tax, call it, I don't know, $1,800 or something. That deal has since cashed out. That deal is worth all 3 paydays to us. Now, this is what's mind blowing for people. We bought it for 183.9. Our profits were about 130 grand on that deal because of the power of the principal pay down and some other components we built into our 3 payday system.
How many years was it from? So you bought it for 183.9. You then rented it out.
We actually do rent to own. Good question, because I don't want to be a landlord. So I want a buyer in that house that needs time to get financing. One of two reasons usually. One, they left corporate America. This is big now and it's growing, and they started their own business and they're not bankable yet. Many of them don't know that. They have cash, they have credit, they go to the bank and they can't get financed yet. They usually need 2 years of what the banks call seasoning to go and prove their new business or their new income. So we deal with that pretty heavily where they need a rent to own with a rent while they're getting their financing. And we have it built in with a set purchase price and a set date that they take that down and that cashes everybody out. Or they had, COVID's a great example, they have a life event and the credit gets beat up or a death or a divorce. Legitimate crediting, not 40 years of bad history and they can't keep their credit good. But a
Yeah.
legitimate history where you can see, oh yeah, they got a bad break, let's help them out. They get credit repair and they get financed. That's our rent to own program. So we're setting these people up to win. They just need time.
So, for example, in this case with the 183.9 house,
Yep.
you close with the seller. Seller takes back 100% of the paper.
Yep.
And then you're on the hook for, I think you said 900 and something a month.
Yep. And it's contingent upon finding the buyer. All our deals are. Now, we can make exceptions, but that deal was contingent upon finding our tenant buyer. So you're never at risk. You usually have a window of 90 days where you're trying to find this buyer to go ahead and occupy that property.
So you put that in as an explicit contingency in the purchase?
Yeah, all our deals. Now, are there deals, Roger, where we go, hey, this is amazing buy. We're getting equity at the beginning here and the seller's got to leave. Sure, that's a decision you make after you have a few deals in the hopper. But when you're brand new as a community member with us, it's important those are built into your agreements already.
So that one, the rent presumably at least covers your
Yeah, it was
monthly mortgage
15 in
payment.
that case, 1,500 less a small insurance payment because we have to do that. We own it. And then we paid out to sell at 923. So we had nice cash flow,
Uh,
high threes, low fours every month. Yeah.
What do you figure, not counting the financing, but there's insurance, there's taxes, there's presumably some maintenance. How do you calculate that? You must have some rules of thumb.
Yep, yep. All maintenance, repairs, everything transfers to the buyer who's in the home, just like they owned it. They just don't have a loan in place yet. The only thing we're paying is insurance. Taxes pass on to them just like they were getting a loan. They have to pay their expense plus the taxes. So all that gets passed on. They're getting, and this is the conversation I have with them. I'm not a landlord. You're a buyer. You just don't have your mortgage yet. I'm giving the opportunity to lock in your price like a buyer, to capture equity or lose if the market crash like a buyer. You're a buyer for all intents and purposes. We're treating you as such. And when you get your loan, then you'll have the deed. That's how I explain it to them.
So is that rent then above market for a regular rent in the area?
Yeah, that's a good question because they won't qualify if you do that. You can't have this exorbitant rent going on. It's usually market. Yeah. A, you wouldn't fill it. And B, the bank doesn't like to see that because then they feel like you're trying to pad it to show that they can buy the next property or get their mortgage for that property. No,
Which
usually market.
bank? Which bank are we talking about?
Their eventual financer because they can eventually get an end loan after they fix their credit or show that they've been at their new job for 2 years or the new business. They're eventually getting an end loan, which is allowing us to cash out the seller and get our profit on the back end.
Uh-huh. So on this particular case, you rented it rent to own for 1,500 a month. Your payments are 9 and change to the seller. You have some
Yeah.
taxes, you have some insurance, and then is it positive cash flow for you on a monthly basis then?
Yeah, because the only thing that came out of our net, remember, because they're a buyer, they're paying taxes, maintenance, everything. The only thing that came out of our 1,500 is small insurance monthly.
Oh, okay. And then that
Everything
particular,
else passes on to them.
so when you put this rent to own or owner in, he's got like some date certain in the future where he buys it for a price certain.
Yeah, on or before a date. In this case, we set it up as 4 years originally. Now, there's a twist to this positively that I'll give you in a minute, but we set it up for on or before 4 years. So they had some room, some ramp to get there. In this case, it wasn't a new job, it was credit. They had to get credit repaired. And there's 5 family members actually. So they came in with, I'll tell you how the paydays worked on this. They came in with 15 grand down. These days we wouldn't take that little because we sold it for like 230. But back then we did. We took 15 grand down and then we took that spread monthly. So payday 1 is the 15 grand, payday 2 is the monthly. Payday 3 is all of the principal pay down that's accruing at 923 a month, plus the markup of the property. So payday 3 gets pretty lucrative on these free and clear deals.
And you're doing 5 to 10 of those a month?
Not all free and clear. Some don't have quite that much principal paid down. I wish they all did because some of them have underlying existing loans that have your conventional principal paid down every month. But yeah, the communities and us, yeah.
Okay, and is it mostly like what's the kind of factors that you look for in a seller?
Motivation, really, because I'll get slips. We have virtual assistants call for us first, calling sellers. And I'll get the lead slip over, we call it a property lead information sheet, and I'll just look at their motivation is because I want to know where they're going, by when do they need to be there, and most importantly, what if that doesn't happen? Hey, Chris, I'm selling on the open market. I get a realtor. I get it. Everybody wants to sell right away. What if it doesn't happen? Well, no, it's got to happen. I have a job changing, or no, it's gonna happen. I gotta move for family member or health or whatever. Those are motivated sellers that will probably work a deal with us. If it doesn't sell, I'll keep it. Forget it, I'll just stay here. But they're not motivated, right? So I look for motivation with them. And then of course the math has to work. But without 3 paydays, it's not about trying to grab that property like a flipper or a wholesaler would for 60 or 70 cents on the dollar. We pay market value sometimes because as long as I get my term to get that market paying down my principal and other terms, then I'm fine. I don't get caught up on price. That's why we don't compete with the flippers and the wholesalers. And the sellers, frankly, love it because they're used to getting hit with those guys got to steal the properties at a low price.
What's the kind of sweet spot in terms of, say, market value or something like that?
It's just below and just above the median, and that differs, right? I have 2 coaches in California that work for us that came to us as students at first, of course, and they made their way to coaching. One of them, Rusty's in Southern California. If he gets a property under $1 million, that's odd. So his median is a lot different than mine, but just below and just above the median. For me, for our family company, that 290 to 690 range is sweet because that's first time buyer. And in my opinion, one of the reasons I like singles is people aren't going to stop getting married and buying their first home and do what they got to do. So that's an easy market to live in that sweet spot. Whereas Rusty's might be 900 to 1.5, and it behaves just like ours does. Only his 3 paydays are much greater. He doesn't do a deal that's under 100 grand profit.
Uh-huh. What constrains you? Is it ability to find the properties? Is it ability to find the subsequent buyer? What's the part that actually limits how much you can
Everyone
do?
asks this, what is it? What's harder, right? Or they'll say, if I get a property, how do I sell it? The harder part is getting the property, right? It's the skill set to talk to them and to get them an agreement. And the easier part is exiting it. Why? Because right now, it doesn't get any better, I don't think, in time here. It doesn't look it. You've got about in the range, every market's different, but in the range of 20%, if you talk to top mortgage brokers, 20% of their buyers are qualifying right now. Out of 100 apps, they get 17 to 20 through the door. So what about that other 80%? They're not all great rent-to-own candidates for us, but it's a big pool, right? And we have a system that sifts them through to find out which ones deserve to be in a rent-to-own versus they're a mess, like I said, credit-wise forever. They don't deserve to be in a rent-to-own, they're just renters. So it's easier to sell on our program than it is to acquire the property. The key is getting the property. You'll sell it. You'll get, recently Rick in New Hampshire comes to mind. He used to work for the federal government, 30 years he worked for the government. He came to us, he's now a coach, but his first few properties, Roger, he had 500-600 inquiries because you're offering no immediate bank qualification needed if they can jump through all the other hoops. That's a big pool right now of buyers that need your help. That's a great, healthy environment. They need your help.
How does it work with some other types of property? Just talk through some of them, because I guess those sellers would be different and the buyers would be different.
Yeah, we bought our own office building this way. I sold it a year and a half ago, but we bought it in 18. So mixed use building, not a house. Seller had a big sign on a busy road for sale by owner financing. He said to me when I walked in and met him, Chris, realtors are coming to me with full price offers. I don't want that. For tax reasons and estate plan reasons, I want to owner finance. See, some people want that, right? It was debt-free building. He bought it originally, thought his son would take it. His son left to Chicago as a lawyer, and he's left with this big building. And I didn't know at the time, he probably did. He was sick. So the intention was to get his wife and his son set up with an income stream versus a building, right? So I bought it in 18. I bought it a bit of a hybrid structure. He was a math guy and a big property owner and wanted interest. I'm used to paying principal only. So what we did was we created what I call hybrid. We created 18 months. We bought this building for $550. We created 18 months of principal only payments. And then whatever was left at the end of that, amortized that over 30 years at 5.2%. So he got the rate he wanted, but he got it after 18 months of principal payments. That's how I worked around that. Because when I first said principal, he thought I was nuts. He's used to conventional real estate. And we came to a nice win-win. He thought it was fair. As long as it's fair, right? The seesaw has to be balanced a little bit. So we bought that building. The exit was not a rent-own, clearly. It was a building where I had my own companies. And there was also an Allstate insurance in there and another small rental. So it worked cash flow wise. We improved it over the years as we are in the business. So we just tweaked it over the 3 or 4 years, whatever. It was 5 years. And then I sold that for $1.2 million. We bought it for $550, maybe put a couple hundred into it. So it served us well cash flow. It hammered down principal right away. It served our companies, and we had a great hit on it and we sold. So that's a totally different asset class.
How many different asset classes have you and your coachees or whatever you call them, students,
Yeah.
how many have you operated in?
I'd say primarily anything commercial, mixed use, mobile home parks. I have a student that just goes after mobile home parks on our financing. That's all they do. And multis, of course. I bought multis myself, but I target, again, free and clear multis. So I can structure these creative deals with them.
Uh-huh. And so what's the benefit to the seller? Why? I know you gave some examples, but what kind of categories of seller benefits do you tend to think in terms of when you go to see somebody?
They like that building owner I talked about, usually for tax reasons, don't want to get whacked all up front. They want to spread that out because they're just going to pay a proportionate amount of their gain each month. They're not going to get whacked out all up front in the sales price. Estate planning for sure. We did a deal with a woman, free and clear, in her late 90s. My son-in-law did this, and our partner. He went into this woman's home, negotiated with her for, gosh, 3 or 4 months at a time. She was hard of hearing, so he had to go to her house. And all she wanted, Roger, in front of her daughter, told us this: I don't want my kids to get all the money. They're just going to blow it. She was going into a nursing home. She wanted the money wired there. This is a 4-year deal in a single family home. She said at the end of the negotiation, sitting down with our attorney in her house, these guys treated me like I was family. I was an attorney for 30 something years. We didn't know this. She was an attorney for 30 something years and let us go through the whole process before she told us this, and said we treated her great and was excited to close. And we ended up wiring that nursing home. The deal was going to close out during COVID. Our tenant buyer defaulted because of COVID. So we called them and asked them to extend it. And they said, no, we can't. My mom's in a nursing home, etc. She passed away literally weeks after the final cash out. So she just wanted her kids not to get that money right away and the cash flow to come into the nursing home. And that's exactly what happened. So everyone's different, but that was a pure estate planning plan and to keep the money away from the kids. Believe it or not, that comes up more times than you can imagine, where they go, I don't want my family to get all the money right now. I want them to have it over time.
What's the size range? I know you talked about in California, the homes are much bigger or
Yeah.
much more expensive. What's the kind of size range that you guys deal in, like yourselves? What's your preferred size?
Preferred is definitely under 2 million. It gets slim pickings once you get up there, and it's a little bit different strategy with owner financing instead of rent to own. So I prefer to be in the sweet spot, again, around up and down from the median, but I don't like to see stuff over 2. And if it's a new student and they get all excited because it's high end, I just set their expectations a little bit to say, look, there's not the same amount of buyers out there. There's not, whether you're selling conventional or in terms when you talk the higher end. So I like the median still.
Is like the majority of deals that you do are single family homes?
Majority, yeah, until somebody that runs across a deal like, hey, I got this, what do I do with it? Then I start to teach them that, or they've got aggressive goals and they're running out of leads in their immediate area. Then I teach them how to do some niche lists. Like I bought a 4 and a 6 family by doing this small 300-piece mailing, tiny, and I niched the mailing to go to 4 to 10 unit building owners that were free and clear. That's a small mailing. But each time we did that small mailing of almost 300 pieces, we bought a house, we bought a multi. So if they want to diversify, hey, Chris, I'd like to keep some of these, or hey, I'd like to get an office building like you did, then we can start bringing in other asset classes. I just don't want them to come out of the gate. Picture most of our people coming out of corporate America, they want to replace the W-2 and then start throwing all these variables at them. I want them to get to some cash quick as possible and then start layering on. And I call it wealth stacking, but then start layering on other asset classes.
I want to change the subject a little bit, or the angle a little bit, and talk about your coaching program. Take us through somebody who just heard about you to that person finishes his or her first deal.
Yeah. So I'm big on free, first of all. I'll do this at the end of your show, but I'm big on free because there's so many things in real estate and they're all great niches. I'm not naive to say I was the only one. I'm biased, but I'm not so naive to say that's it, right? So I want people to, for free, get into the book, get into some of the free stuff on YouTube, look at all that stuff. And then if you say, oh, I see what Chris was saying, I could get my hands wrapped around that. It's a positive environment. Great. Then there's an online academy, like the entry level, and we call it Apprentice. The Apprentice people get 12 weeks. We just started this about a little more than a year ago. It's the best thing we ever did. 12 weeks of group coaching. So they get to see, taste, touch, feel the community a little bit. They're on Slack with us all. They get to see what it's all about and the successes and the challenges. And that comes with a boot camp here at the office, an event in Boston. It really loads them up. It's essentially 12 or 13 grand worth of stuff for $1,500. It's crazy good value. And again, we never had it. The reason we came out with it is we always had these programs where we partner on deals, but so many people would be afraid they wouldn't come in the community. We're like, okay, we're leaving a lot of people behind. So that's why we came up with that sort of entry level. After that, they'll decide if they want to do deals with us. And if they do, there's different ways to participate in that because we basically are joint venturing the deals essentially and revenue sharing on them.
So it takes somebody, I think you said 12 weeks. Did you say 12 weeks?
That's a 12-week program to stop people off to see where they want to go next, or they get through that and they go, got it. I can do this. I'm confident I can do it on my own now. I'm ready to do that too.
Do you have just one coaching program, or do you have like different levels, or how does that work?
There's different levels. So that's the apprentice. And then after that, we have what we call the associate levels. And those, when I said we're in 80 markets, that's what I meant by that. There's associates that are doing deals all over the country. There's different levels to participate there, depending on what revenue split they want, depending on their goals, depending if they're going to be full-time. There's a home for everyone. They just have to, we go over that on a strategy session, say, okay, what's your ideal? How much and how quickly do you need to make? And we go through that with them on a kind of a custom basis.
If someone is listening and they say, this really sounds interesting, what would the next thing to do be?
I would give you two things because, again, they're both free. I would grab the books. I created a link for your tribe in particular. Just go to wickedsmartbooks.com/Roger Silk. So it's easy to remember from your show, and I'll know that people came. So wickedsmartbooks.com/Roger Silk. Then, if you don't mind dealing with my New England accent for another 55 minutes, it's a free class. It's called Master's Class. And they can get that at smartrealestatecoach.com/masters class with an S, Masters Class. And that'll give you the A through Z. So the book does it and the class does it. And we don't hold stuff back. A lot of people say, well, do this, and then you got to do this. These two things will get your feet wet. And then there's probably 500 deals exposed on YouTube now under our Deal Structure Sunday kind of playlist. Just type in Smart Real Estate Coach on YouTube and you'll get hundreds of deals. You can watch them and see what we do.
Chris, I wish we had more time, and it's very interesting. What have I not given you a chance to talk about that you would like the audience to hear before we wrap this up?
Yeah, if you're looking for real estate in general, remember I said earlier, there's a lot of great niches. I got a lot of great friends in different niches. Do this for yourself, whether we ever talk or not. Three things, simple. One, find a niche that you can get behind because there's different kind of personalities, I'll say, to each one. You can flip land from being behind a computer if you don't like dealing with people. You can do what we do if you like kind of win-win and helping buyers and sellers. That's what we got. So there's different reasons to do it. So find out which one you want to do. Second, then find a group or a meetup or a community, in our case, a community, where you go, okay, I can see that they've got the experience, they've been through different ups and downs in the marketplace, because that's important. I don't care what niche you're in. You're going to have changes in the marketplace. You might as well hang with someone that's been through it. And that you can get behind from a kind of a mentor space or someone you can follow, meaning I know, and I'm sure you know, a bunch of people that have been successful, but they messed up relationships over it, or they messed up their family over it, or they messed up their health over it. So I'm talking about someone that you get behind that's been through a bunch of stuff, but also has been someone you could role model, and you're proud to do that. And then third, once you do that, put the blinders on. This is the biggest thing. For 3 years to 5 years, put the blinders on and don't deviate from that community or person, because if you do that, you'll have a great experience. It's the people that get marketed to, in my opinion, too often online with all these promises to make $1 million tomorrow. I'm never going to be the one to tell you that. I'm going to tell you how hard it is, but there's a big upside too. So put those blinders on for 3 to 6 years or 3 to 5 years and know that you'll be fine if you just do that and don't get shiny object syndrome. 3 simple, but not so simple to execute steps.
Like a lot of things in life, they're easy to say and not so easy to do. I'm just going to ask you one more time to repeat where the audience can go to learn more.
Thank you. So wickedsmartbooks.com/Roger Silk or smartrealestatecoach.com/masters class. I said, or it could be and.
Chris, it was really fascinating. Thank you very much. Really appreciate it.
Appreciate you having me on, Roger.
Thank you for listening to another episode of Sterling Insights. Stand out and supercharge your assets, where we provide the info you need from successful leading financial advisors, lawyers, and CPAs. Your hosts, Roger and Catherine Silk, invite you to learn more about Sterling Foundation Management by visiting sterlingfoundations.com.